Hi, John McElroy here, talking all things automotive. Unbelievably, the auto industry is actually shrinking, or at least in mature markets like North America, Western Europe, and Japan, it is. Incredibly, vehicle sales in those markets are lower than they were 10 years ago. And the revenue of the 6 largest legacy OEMs, when adjusted for inflation, have barely budged at all, or even shrunk. This will likely set the stage for a market share war, the likes of which this industry has never seen. A decade ago, the future sure looked brighter. In 2010, industry forecasters predicted that global sales would top 100 million new vehicles a year by 2020. They thought that sales would top 20 million a year in the US by 2020. But it never happened. Global sales peaked at 92 million vehicles in 2019, and US sales peaked at about 17 million. The COVID pandemic and chip shortage chopped global sales down to 89.3 million in 2023, and US sales to 15.5 million. And while sales will likely recover to their 2019 levels, the mature markets will probably never go much higher over that again. By the way, check out my report on Peak Auto as to why millions of households have dropped out of the new car market. I came to all these conclusions after going through the sales, revenue, and stock prices of Toyota, Volkswagen, Hyundai Motors, General Motors, Ford, and Honda over the last 10 years. And the numbers really tell a story. I would have loved to include Stellantis in this group, but Stellantis didn't exist a decade ago. Let's start with Toyota, since it's the biggest car company in the world. From 2014 to 2023, its global sales increased by 1 million units to 11.2 million vehicles, a decade-long growth rate of 9.8%. That's less than 1% a year. Its revenues grew by 44.6% to 37 trillion yen. But over that time period, the yen devalued against the dollar by 42%. And since about 75% of Toyota sales are outside of Japan, its increase in revenue has a lot to do with the weakening of the yen. This chart, which shows 2014 on the left, shows Toyota's revenue growth in yen with the blue line. And the orange line shows the same revenue but in dollars. And the right-hand side of the chart shows the big ramp up in the yen as it devalued against the dollar. As of right now, Toyota stock is trading 177% higher than it did in 2014, which is a great return for shareholders and is the best performance of this group of legacy automakers. Volkswagen is the second largest automaker in the world. From 2014 to 2023, its global sales fell by 900,000 units down to 9.2 million. Its revenues grew from 202 billion euros to 279 billion, up 37.9% or less than 4% a year on average. This chart from 2014 to 2022 shows Volkswagen's revenue in nominal euros with the blue line, while the orange line shows the revenue adjusted for inflation. As you can see, the company hasn't grown that much. Adjusted for inflation, VW's revenues are up 8% over the decade, but that's only 0.8% a year on average. Clearly, investors don't like what they're seeing. VW AG's stock price is down 63 euros a share, or 31% compared to a decade ago. The Hyundai Group, which includes Kia and Genesis, sold 7.8 million vehicles in 2014, but only 7.2 million in 2023. So it's slightly smaller than it was a decade ago. But thanks to moving its brands upscale, revenue grew by 73%, the highest by far amongst these automakers. As the chart shows, even when adjusted for inflation, Hyundai was able to grow its revenue significantly in the last 3 years. And while Hyundai stock is only up 7%, Kia stock, which is traded separately, is up 116%, and it's on a tear right now. Honda, though, also had a tough decade. Last year, it sold 11% fewer cars than it did in 2014. Its revenue was up 35% in that time, but as already pointed out, the weakening of the yen helped inflate that revenue number. Honda stock is up 30%, a growth rate of about 3% a year on average. Not great, but it's better than putting the money in a bank account. General Motors has shrunk the most of any automaker, mainly because it abandoned so many global markets, notably Europe. In 2014, General Motors sold 9.9 million vehicles. Last year, that dropped to 6.1 million, down 38%. Even though it's selling far fewer vehicles, though, GM's annual revenue is $16 billion higher than it was a decade ago, yet adjusted for inflation, it should have been $30 billion more, just to match what it brought in a decade ago. As this chart shows, from 2014 to 2023, GM's nominal revenue in blue has gone up, but on an inflation-adjusted basis, in orange, it's actually lower than it was in 2014. And this helps explain why its stock price has gone nowhere. The price is exactly where it was in 2014. And Ford's a similar story. With global sales of only 4.4 million vehicles, it's now selling 30% fewer cars, trucks, and vans than it did 10 years ago. And while its 2023 revenue of $176 billion is up 20%, it should have been up another $13.7 billion just to keep pace with inflation. Just like General Motors, on an inflation-adjusted basis, Ford brought in less revenue in 2023 than it did in 2014. And this is a key reason why Ford stock is trading nearly 27% lower than it did in 2014. What these numbers show is that the major automakers here are stuck in a rut. Yeah, some, like Toyota and the Hyundai Group, are doing better than the others, but it's all relative. They're really not doing all that great. So here's what the industry is going to have to do. First, if automakers want to grow, they've got to be in the growing markets, like Africa, Southeast Asia, India, and South America. Second, if automakers don't want to go into those developing markets, and they may not want to because they tend to be very low profit margin markets, then they need to figure out ways to drastically cut car prices to entice more buyers back in the mature markets. But they have to cut prices without sacrificing profit margins, which means they need to be very clever in how they cut costs, like using Tesla's unboxed assembly process, or things along those lines. Third, and they are trying to do this one, they need to come up with new sources of revenue. This is why automakers are trying to sell subscriptions to services like Tesla's full self-driving, GM Super Cruise, or Ford's Blue Cruise. But it's going to take time to move into new markets, to slash manufacturing costs, or dream up services that customers will want to subscribe to. In the meantime, since the major markets are not growing, they're going to have to fight tooth and nail to hold on to the customers that they've already got. Because if you lose customers, you lose sales volume. If you lose sales volume, you lose manufacturing scale. If you lose manufacturing scale, your profit margins fall. And if your profit margins fall, it's only a matter of time before you go out of business. And so I believe we're going to see a war for market share like we have never seen before, where sales incentives and price cuts rule the day. In fact, in the EV segment in China, it's already begun. The price war there started over a year ago and shows no signs of letting up. In fact, it's now spreading to ICE cars, and it's only a matter of time before it spreads worldwide, or at least into those markets that are no longer growing.